What's up, JPIANs? Today we'll be talking about the conceptual framework. Basically, first thing to remember, it's only a framework and not a standard. Hence, the rules in the standards are given priority and are to be followed when dealing with appropriate transactions. Only when there are no specific or relevant rules shall we refer to the framework. The framework deals with the following: the objective of general purpose financial reporting, qualitative characteristics of useful financial information, financial statements and the reporting entity, the elements of financial statements, recognition and derecognition, measurement, presentation and disclosure, and finally the concepts of capital and capital maintenance. The main objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to primary users to help them in making decisions about providing resources to the entity. For financial information to be useful, the framework tells us that it should possess fundamental and enhancing qualitative characteristics.
Ta-da!
Fundamental characteristics makes information useful to users. Here, information should observe relevance and faithful representation. The absence of any one of these characteristics would not make information useful. Enhancing characteristics enhance the usefulness of information. This include verifiability, comparability, timeliness, and understandability. Or VCAT for short, though I like NOVA more. There are three types of financial statements. First, statement of financial position, which shows assets, liabilities, and equity. Second, statements of financial performance, which show income and expenses. And third, other statements which disclose other necessary information, such as cash flows and distributions to equity holders. Statements are usually prepared using the going concern assumption, which basically means i-assume natin na may forever. The reporting entity is an entity who must or chooses to prepare the financial statements. It can be a single entity, a portion of an entity, or more than one entity. There are 5 elements of financial statements. An asset is a present economic resource controlled by the entity as a result of past events. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. Equity is the residual interest in the assets of the entity after deducting all liabilities. Income are increases in assets or decreases in liabilities, resulting in increases in equity. Expenses are decreases in assets or increases in liabilities, resulting in decreases in equity.
Elements of financial statements.
According to the framework, we recognize elements only when they provide useful information or when they possess the fundamental characteristics. Derecognition happens when the item no longer meets the definition of an asset or a liability. There are 2 basic measurement bases. First, historical cost, which is based on the transaction price at the time of the recognition of the element. And second, current value, which reflects the conditions at the measurement date. Methods under current value include fair value, value in use, and current cost. Just like you and your partner, we emphasize effective communication in presentation and disclosure. Effective presentation and disclosure tells us that we should first focus on objectives and principles of presentation and disclosure. Second, group similar items and separate the similar items. Third, aggregate information but not to the point of obscuring the information. There are 2 concepts of capital as discussed in the framework. First, financial capital. This is synonymous with the net assets or equity of the entity. The financial maintenance concept tells us that profit is earned only when net assets at the end of the period is greater than its beginning amount. Second, physical capital. This is the productive capacity of the entity. The physical capital maintenance concept tells us that profit is earned when physical productive capacity increases during the period. And that was basically the conceptual framework. For more detailed and in-depth information, you can refer to the framework itself. This is Nala. Stay tuned for another episode of Accounting Basically. Stay safe and stay informed, JPIANs.